Ladies and gentlemen, here in this video, we will go over the biggest headlines moving markets today. First and foremost, President-elect Donald Trump says he will use economic force to make Canada the 51st U.S. state. And U.S. President-elect Donald Trump has stated that he won't commit to not using military force to capture the Panama Canal and/or Greenland, and that he wants to change the Gulf of Mexico to the Gulf of America. Some people are asking, why in the world would the US want Greenland or even Canada for that matter? And at this point, we just don't know. I don't think this is the reason why markets are moving lower today. The headline S&P down almost 1%, the Nasdaq down well over 1%. The Nasdaq currently down about 1.5%, the Russell 2000 down 0.7%. The Dow is down 0.1%, and the VIX is soaring 8% today. Trump has announced a $20 billion foreign investment to build new U.S. data centers. Emirati billionaire Hussein Sajwani, a Trump associate and founder of the property development company Damac Properties, is pledging the money. And this guy said down at Trump's golf course in Mar-a-Lago that he's been waiting, quote, years to increase their investment in the U.S. to very large amounts of money. This follows SoftBank's CEO that announced plans to invest $100 billion in the U.S. and create 100,000 jobs over the course of Trump's 4-year term. The pressure on markets today is coming from the economic data that was released. With the ISM Services PMI, on the headline, it came in pretty much in line with expectations at 54.1 versus consensus at about 54. But when you look at the components of ISM Services, that's where Wall Street is getting a little concerned. Specifically in services prices that came in at 64.4. The expectation was 57.5. We were actually expecting prices to fall, but they skyrocketed. Now, here's the deal with ISM services or ISM data in general. Just let me read you this here. It says, the non-manufacturing ISM report on business is based on data compiled from purchasing and supply executives nationwide. Survey respondents reflect the change, if any, in the current month compared to the previous month. This is a survey, okay? So why did purchasing and supply executives nationwide expect higher prices? Wall Street is saying this is because of tariff expectations. Now, the good and bad news here, the bad news is when expectations are that inflation is going to go higher, inflation normally goes higher. The good news is the expectation is probably too high already for tariffs. Okay, think about it like this. We were promised really high tariffs. Okay. Wall Street kind of shrugged that off for a while. Now we're like, oh crap, the inauguration is January 20th. If we're going to get these high tariffs, that's going to be bad for inflation. Trump is allowing or opening up the door for, let's say, a 10% blanket tariff on everything, which, if we were not preconditioned for that, if we had no idea tariffs were coming, and one day we woke up and there's a 10% tariff, oh my gosh, markets crash, okay? But if we're expecting something that's much worse than 10%, and all we get is 10%, that is better than expected. It's kind of like a company that is on the doorstep of bankruptcy that everyone expects is going to have a really bad earnings, and they come in with bad earnings, but not bankruptcy-like bad earnings. That is all of a sudden a big positive catalyst. Although earnings were bad, they were not as bad as expected. And I think that is how we are setting up in markets probably after the inauguration. We're going to say, oh wow, a 10% tariff, that's not nearly as bad as what it could have been, what Wall Street was starting to expect. expect. Now, the other news we had today was JOLTS job openings that came in at 8.098 million versus expectations of 7.7 million. So about 300,000 more job openings than we were previously expecting. That supports the narrative that the labor market is not as weak as some people thought. This is pushing up 10-year Treasury yields about 7 basis points today to 4.68%. If you're rounding here, you'd go to 4.69%, which is the highest level we have been at since at least November of 2023 and back here in April of 2024. Now, in October of 2023, we actually hit a high of 4.98%, closer to about 5%. So that's kind of the bad news. If tariff fears and inflation fears rise further from here, we could see the 10-year Treasury yield rise even further, and that would put pressure on markets. But I personally think it's going to be hard to sustain these levels on 10-year Treasury yields if inflation does not really skyrocket from here. This is pricing in inflation skyrocketing from here. So if that does not happen, 10-year Treasury yields are going to come sharply back down again. And when we look at the percent of stocks trading above their 50-day moving average, here on the day today, it's sitting at 36.6%. That means 64% of stocks are currently in an active decline. Whenever you're in a bull market and 65% of stocks are in a decline, you want to be buying that dip. Okay. Now, is this the start of a new bear market? I mean, anything's possible, but I don't think Trump wants to be the guy that came in after, two back-to-back 20+% gains for the S&P and destroy that. I don't think Trump wants to be the guy that came in and ended the bull market. Maybe that's my opinion. Maybe that's speaking out of my ass. I don't know the guy. Maybe he wants to destroy the bull market. I don't think so, though. I think that's probably not the plan here. And if that's not the plan here, then you can only do so much, before that happens. Markets are already in a weak place, and I do think we are expecting a lot of bad news already. Okay, especially on tariffs. Now, CNN's Fear and Greed Index is coming in at 38 today. Yesterday, you were at 36. Considering markets are selling off today, I think we're probably going to end the day at like 34, maybe even 33. Again, anytime you're in a bull market and CNN Fear and Greed Index is in fear, you typically want to be buying that. Market momentum is extreme fear, stock price strength, extreme fear, stock price breadth, extreme fear. Put and call options is greed. Market volatility is neutral, safe haven demand in fear, and junk bond demand in greed. Also have the most recent AI investor sentiment survey that's coming in at 35.4% of investors that are bullish, 30.4% of investors that are neutral, and 34.2% of investors that are bearish. So you're kind of even across the board here. This is far from an optimistic market. Also in the news today, stock trades for both Democrat and Republican politicians outperformed the S&P 500 in 2024, gaining 31% and 26% respectively. 5 politicians actively traded an annual gain of 100% or more in 2024, per unusual whales. Trump says today, if hostages are not back by the time I'm in office, all hell will break out. This is in regard to the Americans currently held by Hamas. And Bridgewater, the largest hedge fund in the world, has dismissed 7% of its workforce as per Reuters. And Danish Prime Minister says Greenland is not for sale as Donald Trump Jr. visits the island. January 3rd marked the 10th consecutive session where fewer than 1% of S&P stocks hit a new high. That is bad breath. 11 of other streaks since the great financial crisis all preceded a rally in equal weight S&P. That is the RSP that we frequently monitor here on this channel. 2 weeks after the signal date, price has been higher 100% of the time. That would be on January 20th, improving January barometer probability. And 1 year later, you tend to be up about 19% with a 91% positivity rate. The largest max loss was about 4.4%. The largest max gain was 20.5%. Only 52% of S&P 500 stocks are trading above their 20-day moving average, the fewest in almost 14 months. Again, I like to look at the percent of stocks trading above their 50-day moving average and not just looking at the S&P. This incorporates all of our markets. And you're at 36.6%. But if you're looking at the 200-day moving average, which is even worse, I mean, these stocks are in an even worse downtrend if they're below their 200-day moving average. Yeah, markets, they're not in a great place. Now, how the markets work for anyone that is confused is when markets are super negative or super positive, you need to continue to see reaffirmations of why markets are super positive or super negative. So meaning when markets are this negative, you need to continue to see negative news and negative affirmations, right? To continue to be this negative, okay? If you start to get things that are better than expected or a little bit more positive, markets tend to reverse and move higher. Same is true when markets are overly optimistic. You need to continue to see good news, or if that good news starts to turn negative, it's hard to continue to see a euphoric market. Now, Mark Newton writes on X, he is with Fundstrat, the chief technical strategist. He says the flip side to all of this internal deterioration is that sentiment has begun to retreat pretty sharply in recent weeks as the media's narrative about Trump tariffs being inflationary becomes consensus. AAII Bull Bears is now down to neutral, which is the AAII Investor Sentiment Survey. I call it AI Investment Survey just to be short, but he's referencing the same thing. He says a far cry from most of 2024. When the media says something's a surety, it's almost always wise to bet against that. So he's saying everyone thinks inflation's going to surge under Trump. It's probably a good bet at this point to bet against that maybe tariffs won't be as inflationary as some expect. Now, the next big catalyst for our markets is going to start on January 15th. Broadly speaking, that is the start of earnings season. Now, we do have some data throughout the rest of this week that I will share with you. Tomorrow morning, you have initial jobless claims and the ADP employment change. That is the private jobs report, expecting 140,000 jobs. Fed Waller speaks at 9:30 in the morning, and you have the FOMC minutes tomorrow at 2 p.m., and then the consumer credit change at 3 p.m., expecting $10.5 billion of debt to be added to people's balance sheets. Thursday, we are not going to get much of anything because the markets are closed. You will get some Fed speakers, Fed Barkin, Fed Schmidt, Fed Bowman, and the Fed balance sheet. You will get the Challenger job cuts, but again, stocks are closed, so I don't know how much we're going to react to that. On Friday, markets will be open, and stocks will be closed on the 9th because to honor President Carter and a day of mourning. On Friday, you will have non-farm payrolls and the unemployment rate. Non-farm payrolls are expected at between 154,000 and 200,000. Last month was 227,000, and the unemployment rate is expected to tick upwards to 4.3%, which is going to be the highest unemployment rate in this cycle. You will also get the Michigan consumer sentiment, where you have inflation expectations, current conditions, and consumer expectations. So that data will also be important. But let me just tell you right now, you're already so negative on markets that data is going to have to be really bad to, I think, get markets even more negative. I mean, things are just bad already. You look at the RSP, that's down 6% from all-time highs. S&P is only down about 2.5% from all-time highs. So I think there's still some headline risk from big tech. But I think, again, when you look at the internals of our markets, we are long overdue at this point for a broader market rally. And I have to be honest, if you're a bull, you're a bear, it does not matter. If and when markets are this negative as they are now during a bull market, you want to go out and buy something. Okay, put your emotions to the side. Say, hey, historically speaking, when markets are this negative, it's a good time to buy. That's a fact. That's not an opinion. So I think it's a good time to buy. And I think you want to be buying this dip. But hey, I'm not a financial advisor. I'm not a financial planner. Your situation's different than mine. It's different from the next guy. Let me know down below in the comment section what you are doing with your portfolio. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.